Okay, hello everyone. We're from Group J and I'm Rania Zahra Nurrahima. We're here to discuss the case study 1 from institution and financial markets. Let's get started.
I will present a financial evaluation of proposed project, the expansion of Nova Animation Studios. The net present value calculates the difference between the present value of future cash flow and the initial investment. Here are the values used. Initial investment $4 million, annual cash flow $675,000, and 16 years, discount rate 11% or 0.11. The resulting MVP is positive, which indicates that the project is expected to generate more value than its cost. Conclusion: NPV is positive. The project is acceptable. The profitability index measures the value created per unit of investment. Formula: PA, present value of future cash flow divided by initial investment. Result: PA 1.25. This means for every $1 investment, the project returns $1.25. Since PA greater than 1, the project is financially viable. Conclusion: PA 1.25, the result acceptable. The ARR is the discount rate at which the NPV becomes zero. Here are the calculated NPV at different rates. This is the result of the calculation of 5% and 10% NPV. This is the result of the calculation of the NPV of 15% and 20%. This internal rate of return between 15% and 20%. At 0% NPV, $6,800,000. At 5% NPV, $3,315,494.45. At 10% NPV, $1,281,003.33. At 15 NPP, $19,108.54. At 20% NPP, negative $807,546.64. From this, we estimate the IRR 15.12%. Based on the financial analysis, NPV is positive. PI 1.25, which is greater than 1. IRR 15.12%, higher than the 11% required return. Therefore, we recommend proceeding with the expansion of Nova Animation Studios. The investment is expected to be profitable and will enhance the company's competitiveness in the growing animation industry.
Okay, for the case 2 will be discuss uh, the financial analysis for the expansion of Velocity X Motors product line. Our goal is to determine whether this project is financially viable and worth pursuing. So let's drive it right in. To start, let's look at the initial investment required for this project. The total comes to $500,000, which includes $450,000 for equipment and $50,000 for networking capital. This is the foundation of our analysis since it represents the upfront costs we need to recover through future cash flow. Next, we estimate the annual net cash flow for years 1 through 9. Here how we calculate it. First, we calculated the gross revenue by multiplying the number of units sold by the selling price per unit, which gives us $400,000 annually. And then we have the variable cost, which is $90,000. Then we subtract variable cost and fixed cost to get an operating income of $160,000. And after applying a tax rate of 34%, we calculated taxes to be $54,400, leaving us with a net operating income of $105,600. And finally, we added back depreciation, which is 54,000 per year to arrive at an annual net cash flow of $150,600. So for years 9 through so for years 1 through 9, our projected cash flow is $150,600 each year. No, let's talk about year 10. In addition, the annual net cash flow of $150,600, we recover the working capital of $50,000 at the end of the project. This brings our total terminal cash flow for year 10 to $200,600. And finally, let's analyze whether this investment is financially viable using net present value or NPV. In here, we use a discount rate of 10% and calculate the present value of all future cash flows from years 1 to 10. For years 1 through 9, we discount each annual cash flow of $150,600. For year 10, we discount the terminal cash flow of $200,600. After summing all discounted cash flows and subtracting the initial investment of $500,000, we get an NPV of approximately, which is 444,649. So what does this mean? Since our NPV is positive, uh, 40 sorry, $444,649, it indicates that this project will generate value for the fellow CTX motors. Based on this analysis, I recommend moving forward with the expansion as it is financially viable and promising.
My name is Adinda Nabila. I will explain the case study number 3, which is the expansion decision at Quantum Tech Solution. Number 1, break-even analysis. Calculate the accounting break-even number of memory cards the company needs to sell each year. Fixed costs, fixed salaries, 180 million. Depreciation, 800 million divided 5 equal 160 million per year. Total 180 million times 160 million equal 340 million per year. Price per unit 15,000, variable cost 10,000. BEP or break even point, the formula is fixed cost divided price per unit minus variable cost per unit. which is equal 340 million divided 15,000 minus 10,000 equal 340 million divided 5,000 equal 68,000 per year. Total revenue 68,000 times 15,000 equal 1 billion and 20 million. Total cost, fixed cost 340 million. Variable cost 68,000 times 10,000 equal 680 million. Total 340 million times 680 million equal 1 billion and 20 million. Net operating income or NOI, revenue minus cost equals 0. Break even achieved. Quantum Tech Solutions must sell 68,000 memory cards annually to cover all fixed and variable costs. Number 2, strategic recommendation. There are two questions in here. The first one is based on the break-even analysis. Should Quantum Tech Solutions proceed with the expansion? The break-even analysis shows that the company must sell at least 68,000 units per year to cover its fixed and variable costs. The feasibility of this expansion depends on market demand, pricing strategy, and competition. The second one, what potential risks or challenges should the company consider before making the final decision? Before making the final decision, Quantum Tech Solutions must carefully evaluate the risks associated with this expansion. One of the primary concerns is market demand's uncertainty. While the increasing need for data storage solutions suggests a promising opportunity, actual demand for the company's new memory cards must be truly assessed. If sales projections do not align with market realities, the company may struggle to reach the break-even point of 68,000 units per year. A miscalculation in demand could result in overproduction and financial strain.
Okay, next, let's talk about Nexatech solution equipment acquisition decision. We're analyzing two key assumptions: whether loan payments are made at the beginning or the end of the year. This will help us understand the financial impact of each scenario. Okay, here I have assumption A: loan payments at the beginning of the year. Under assumption A, loan payments are made at the start of each year. The after-tax cost of debt is calculated as 5.85%, and we computed total cash outflows, including tax effects and depreciation benefits. As you can see in the table, the present value of cash outflows totals is 172 point 728.065 dollars. And next, I have the assumption B: loan payments at the end of the year. Before, the assumption A is loan payment at the beginning, and now is the end of the year. Now, in assumption B, payments are made at the end of each year. This change the loan payment amount to 55.730.176 annually. After calculating depreciation benefits and tax shields, the PV of COF comes to 173.711, slightly higher than assumption A. Okay, depreciation is a big factor here, with an asset cost of 250 million and a residual value of 30 million over 6 years. Annual depreciation is 36.666.667, which is this is give us a tax shield of 12,833.333 per year, or 77 million over 6 years. It's a significant saving. In conclusion, both assumptions are having similar outcomes in terms of cash outflows. However, making payment at the beginning of the year, or which is assumption A, slightly reduce cost to lower present value. This analysis highlights how timing can impact financial decisions. Thank you. And
Determine the after-tax cost of lease financing considering the tax deductibility of lease payment. The annual lease payment is 52 million Korean won. The corporate tax rate is 35%. Since lease payments are tax deductible, the effective annual cost after tax is calculated as 52 million Korean won times 1 minus 0.35, which equal that is 33,800,000 won per year. Total cash outflow 6-year lease. To understand the total cost over the lease period, we compare cash outflow over 6 years. We use the assumption A, lease payments are made at the beginning of each year. Assumption B, lease payments are made at the end of each year. These assumptions impact the time value of money and overall financial evaluation. Final recommendation: risk to consider, balance sheet impact. Leasing affects financial ratio differently than buying. Interest rate environment: fixed lease may become expensive if market rates drop. Residual value risk: if the company buys the equipment, the project realized value might not be realized due to fast change. Before making a final decision, next stage must consider several financial risks. First, leasing might influence financial ratios shown on the balance sheet. Second, fixed lease contract can be costly if market interest rates fall. A variable rate option or financial hedge could help mitigate this. Lastly, if Nexatage purchases the equipment, it takes on residual value risk, estimated at 30 million won, which may not be realized if technology evolves quickly. This risk is avoided through leasing. Lease total 171,558,661. Loan total cost 181,838,001. However, ownership through a loan can provide long-term financial benefit, including control over the asset. Therefore, if Nexatage priorities cost saving, leasing is recommended. If control and asset retention are more important, then Aloan is the better choice.